In January 26, silver surged to $120 an ounce, a record high. The whole internet was shouting, "Silver is going to the moon." Silver ETF buyers were sending red envelopes in group chats, while silver futures bulls felt they were the chosen ones. 4 months later, it was $77, down 36%. So, is silver going up or down? The bulls got trapped and the bears made nothing either. Retail investors who rushed in during January lost a third of their money in 4 months. If you bought 1 million yuan worth of silver bars in January, your account showed just 640,000 yuan in May. 360,000 had vanished. This kind of roller coaster is not what a normal market should look like. In a market with more than $100 billion traded globally each year, prices shot up and crashed back down like a slingshot. Why? Was someone manipulating it? Did the bubble burst? Or is silver simply a worthless asset? None of the above. Today, I'll show you a deeper reason. The pipes in the silver market are broken. What does that mean? Don't worry. In this episode, I'll explain the complex precious metals market through a simple pipe story, from underground reserves and London vault inventories to Indian wedding silver and the United States government's strategic stockpile. One pipe connects the truth about the entire silver market. Welcome back to Money Daddy Finance Comics. Like first, watch next, and may your path to wealth be long. All right, let's get started. There's a claim going around online that silver has only 10 years left and that all the silver on Earth will be mined out after that. Sounds scary, right? I checked the United States Geological Survey's latest 2026 minerals report, and the data is very clear. The world has about 610,000 metric tons of known economically recoverable silver reserves, while global mine production in 2025 was about 26,000 metric tons. Divide 610,000 by 26,000 on a calculator. What do you get? 23.5 years. Not 10 years, but 23 and a half. So mathematically, the claim that silver will be completely mined out in 10 years simply doesn't hold up. But don't let that number make you too comfortable. 23 and a half years of supply is not exactly generous for a commodity. Iron ore has more than 40 years, and that's enough to keep mining for decades. Silver is definitely tighter than many other metals, but we're nowhere near the apocalypse. So people may ask, if there are still more than 20 years of reserves, why has silver gone up this much? Its $120 peak in January was 6 times its 2020 price. Good question. The answer is the core of today's entire episode. The problem isn't underground. It's above ground, in the market, right in front of the delivery counter. Think of the silver market as a logistics system. Producers are at one end, consumers at the other, and a network of pipes connects them. What flows through those pipes isn't ore, but refined silver bars in standard sizes ready for delivery. Those bars come out of the mines, pass through refiners, and enter vaults in London or New York. Then factories buy them or investors lock them away in safes. The whole process is like one big pipe. Mines are the inlet, consumers are the outlet, and the pipe's capacity determines how healthy the market is. For decades, that pipe was wide enough, and the market rarely had problems. But in recent years, several new outlets suddenly appeared, while the inlet barely changed. The water in the pipe started running short. Here's a more familiar example. Your neighborhood water tower might hold 1,000 tons of water, theoretically enough for the whole community for a month. But what if the pipe connecting the street to your house were only as thick as a chopstick? Turn on the faucet, and all you get is a tiny trickle. A shower takes half an hour, and the neighbors start complaining. The property manager says the water tower is full. So what good is being full? If the water pressure and flow are too low, you still can't use it. Whether the tower is full and whether your home has strong water pressure are two completely different things. That's exactly what's happening in silver. Underground ore is the water tower. Silver that can be delivered today, received tomorrow, and bought at a reasonable price is the water inside the pipe. The tower is full, but the pipe is getting narrower. That's what I mean by a pipe market. People used to think of silver as a warehouse business. Mine it, store it, and sell it whenever someone wants it. That's no longer the case. Silver has become a pipe business. The key isn't how much silver exists, but whether it can flow to the people who need it. Okay, you understand the difference between a water tower and water pipes. Now, this next set of data may be the most counterintuitive part of today's episode. I guarantee it'll sound unbelievable. The data comes from the World Silver Survey 2026, published jointly by the Silver Institute and Metals Focus. Released every April, it's the silver industry's most authoritative annual report. Let me break down the 2026 forecasts. First, demand. Total silver demand is expected to reach 1.126 billion ounces. Sounds like a lot, right? But that's down from last year. Industrial demand is down 3%, and silver use in solar power is down 19%. Yes, you heard that right, 19%. Jewelry demand is down 16%, and silverware is even worse, down 20%. Go to a shopping mall and look around. The silver jewelry counters are practically deserted. Silver is too expensive for ordinary consumers. Demand is shrinking across the board. So in theory, if demand falls and supply stays the same, the market should get some relief, right? If nobody's buying, there should be enough to go around, right? But the report goes on to say that the silver market will still face a shortage in 2026, with a gap of 46.3 million ounces. What? Demand is falling, and there's still a shortage. Yes, this is the sixth straight year of undersupply. 6 years. Since 2021, the market has been short every single year. How big is the cumulative shortfall? 762 million ounces. That's about 23,700 metric tons of silver. It didn't just vanish, it was gradually drawn out of the market's visible inventories. Some disappeared from vaults in London, some from warehouses in New York, and exchange-traded fund holdings changed too. 6 years, 23,700 tons. You might say, wait, that doesn't make sense. If demand is falling, how can there still be a shortage? The answer is on the supply side. Silver has one crucial characteristic. Roughly 70% of the world's silver isn't mined from silver mines. It's a byproduct of copper, lead, zinc, and gold mining. What does byproduct mean? When you mine copper, the ore contains a little silver too. You refine the copper and the silver comes out along with it. That's called associated production. So silver supply is driven less by the price of silver than by copper prices, lead and zinc prices, and the mining plans for those primary metals. When silver prices rise, are mine owners happy? Sure, but they won't open another copper mine just because silver got more expensive. Copper mining has its own investment cycle. From exploration to production takes at least 7 to 10 years. Lead and zinc mines follow their own logic, so the silver price signal doesn't really get through. You can shout, silver prices are up, go mine more silver, and the mine owner will say, I mine copper. Silver is just a bonus. That's why supply is almost completely rigid. Global mine production of silver is expected to reach 844.1 million ounces in 2026, slightly below last year. See, demand is falling, but supply barely moves. Both sides are shrinking, but supply is shrinking more slowly. That leaves a gap in the middle, and it doesn't have to be very large. A shortage of 46.3 million ounces is just over 4% of total demand. 4% doesn't sound like much, right? But what if the market's freely available inventory is already thin? Imagine a city with only 3 days of food suddenly hit by a blizzard, with roads closed for 2 days. Is 3 days of food enough? Mathematically, yes, 1 day would be left. But check the supermarket shelves. Would anything still be there? They'd be cleared out on the first day. A 4% shortfall is nothing in a well-stocked market. But when freely available inventory has already been drained, 4% is enough to send prices and lease rates into chaos. You might say, wait a minute, what about silver recycling? Old jewelry, industrial waste, electronic scrap. Can't we just recover the silver? Yes, recycling is an important supplement to silver supply. Recycled silver supply is expected to reach 211.3 million ounces in 26, up 7% from last year. High silver prices are definitely encouraging recycling. Think about it. At $120 an ounce, even the tiny amount of silver in old circuit boards becomes valuable. Recyclers have an incentive to collect scrap, but recycling has a ceiling. You can only recycle something if there's something to recycle. Much of the silver used in industry is consumed. Silver paste is printed onto solar panels, whose design lifespan is 25 to 30 years. You have to wait until those panels are retired 25 years later before you can recover that silver. Silver in electronic products is even more dispersed. A single phone may contain only a few hundredths of a gram. How many tens of thousands of discarded phones would you need to extract 1 ounce of silver? The cost is too high. Recycling helps, but not by much. Can 213 million recycled ounces really fill a 46.3 million ounce shortfall? On paper, mine production and recycling are already included in total supply. The report still shows a deficit after counting recycling. Recycling is already included, and there's still a shortage. This is the most frustrating part of silver supply. Mine output is rigid, and recycling has a ceiling. Neither route can solve it. The only buffer is inventory, and that's being eaten away year after year. At this point, you might think, so what if there's a shortage? Aren't London and New York vaults still full of silver? Yes, they are. The London Bullion Market Association, or LBMA, publishes London Vault data every month. At the end of April 2026, London Vault still held 27,454 metric tons of silver. More than 27,000 tons sounds like plenty, right? New York's COMEX warehouses hold silver too. So what's the problem? Not all of that silver is actually available. What does available mean? It means silver that can be lent out, delivered, or traded in the market at any time. Metals Focus estimated that by the end of September 2025, 83% of London's silver inventory was tied up in various physically backed financial products. Exchange-traded funds take one portion. When you buy a silver ETF, the fund has to lock up silver in a London vault to back your shares. Physical trusts take another portion. Structured products take another. That silver may be physically sitting in a vault, but legally, it already belongs to someone. You can't just borrow it. The truly free-floating portion available for lending or delivery is about 136 million ounces. What does 136 million ounces mean? The annual market shortfall is 46.3 million ounces, so the freely available portion covers only about 3 years of deficits. Reuters ran the numbers too. At the end of March 2026, of London's 884 million ounces of silver inventory, only about 28% may have been available to support market liquidity. See, it's not that the silver doesn't exist. London vaults are stacked with gleaming bars like little mountains, but less and less of that silver can actually move. It's like a water tower with 1,000 tons of water, but 800 tons already reserved for firefighters, schools, and hospitals. That leaves only 200 tons for residents. Your neighborhood has 300 households, and each uses 1 ton a day. 200 tons wouldn't even last a full day. A large inventory number doesn't mean strong liquidity. A lot of people still haven't understood that. Now, let me bring up a historical example, because silver isn't the first metal to take this path. 2019 to 2020, palladium. You may not know it well. It looks a lot like platinum with a silvery white color, and its main use is in automotive catalytic converters. That catalytic converter in your car's exhaust system contains palladium. Palladium shares one crucial trait with silver. It's also a byproduct metal. Most of the world's palladium comes as a byproduct of nickel and platinum mining in Russia and South Africa. To produce more palladium, you first have to mine more nickel. But nickel mines have their own investment cycles. Around 2018, emission standards tightened worldwide. Europe and China both cracked down on exhaust emissions, and demand for palladium in catalysts surged. But the mines couldn't expand output. You can't tell a nickel mine owner, get the bank to lend you more money, dig up more nickel, and help me produce more palladium. The mine owner would say, nickel prices haven't risen, so why should I mine more? The result? Palladium lease rates briefly soared to 300% a year. Think about that. Borrow $1 million worth of palladium, and after a year, you owe $3 million in interest, for a total of $4 million. This isn't loan sharking. It's the legitimate precious metals lending market. A 300% annual rate means metal was genuinely impossible to borrow. And the price? Palladium rose from under $500 an ounce in 2016 to $2,800 in 2020, more than quintupling in 4 years. And remember, palladium's geological reserves aren't especially small. The metal didn't disappear, liquidity dried up, the pipe was blocked. Silver is now following almost exactly the same path. In October 2025, silver lease rates saw an extreme spike. The market reached a point where silver had a price, but you still couldn't borrow it. No matter how high your offer, they'll say, I don't have any silver to lend you. One trigger, according to the Silver Institute, was a sudden demand shock from India. The platinum lesson is right there. A liquidity crisis in a byproduct metal. I'm not making this up or theorizing. It happened, and nobody was prepared. You may have noticed that silver is different from gold. Gold is mainly a financial asset. Central banks and investors buy it, and jewelry uses it too, but industrial demand is actually very small. Industry accounts for less than 10% of global gold demand each year, so gold prices are mostly set by financial markets. Fed hikes, gold falls, fear rises, gold climbs. The logic is clear. Copper, on the other hand, is almost entirely an industrial metal, so its price is tightly tied to the global economic cycle. Strong economy, copper rises; weak economy, copper falls. That logic is clear too. But silver has one foot in factories and the other in safes. Industry makes up about 57% of demand, jewelry and silverware 17%, and investment 23%. It's part copper and part gold. So when the economy is strong, industrial demand pushes it higher. When the economy is weak but fear is high, investment demand pushes it higher. Good economy, it rises. Bad economy with panic, it rises too. It wins on both sides, but that comes at a cost. When both demands surge, supply simply can't keep up because there's only one supply pipe. Whether factories or investors are buying, it's the same silver. One metal, two buyers, one pipeline. If that pipeline isn't wide enough, it bursts. That's the underlying reason silver prices have gone increasingly wild. It's not just a simple shortage. Two completely different demand forces are fighting for water in the same pipe. Now that you know the pipe is narrowing, who's pulling hardest from the other end? I count 3 straws, and everyone is thicker than you'd expect. The first straw is India. India's relationship with silver runs much deeper than you might think. Indian love for silver is cultural. Weddings need silver, religion needs silver, festivals need silver. But in the past, most of that demand was jewelry and silverware bought for the household, not circulating in the market. That changed over the past 2 years dramatically. In the 9 months from April through December 2025, India imported $7.77 billion worth of silver, up 129% year on year. That's not a 10 or 20% increase, it's more than double. You might say Indians already love buying gold and silver, but this time is different. In April 2026, the Reserve Bank of India formally allowed people to use silver as collateral for bank loans. Think about what that policy change means. Before, an Indian woman might buy 1 kilogram of silver and lock it in a cupboard, passing it from mother to daughter and then to granddaughter. Economically, that silver is dead and out of circulation. Now, silver can be pledged, so it becomes a formal financial asset. You take 500 grams to the bank lends you money, and you use that money in your business while the silver stays at the bank. What does that mean? More Indians have an incentive to hold silver and to hold it long term. They're not selling at high prices to take a profit, they're pledging it to generate cash flow. In India, silver has gone from jewelry to hard currency. India's straw isn't temporary, it's institutionalized, long term, and getting wider. The second straw is China. China's relationship with silver is more complicated. China is the world's largest silver processing country. Silver powder, paste, contacts, and other industrial products made with silver leave China for the rest of the world. In the past, some of China's annual silver output was used domestically and some was exported. China was both an importer and exporter of silver, and global markets saw it as a stable source of supply. But over the past 2 years, that has changed. The driver is familiar: solar power. China makes more solar modules than any other country. Solar cells need silver paste. China is also the world's largest electric vehicle market. Battery management systems, charging ports, and electronic controls all use silver. So do energy storage systems. Large-scale energy storage stations are spreading across China, and their power electronics components need silver. As for 5G, China has built more 5G base stations than any other country. High-frequency communications are taking off, and four related industries are exploding in China at the same time. Domestic demand has swallowed all the surplus that used to be exported. China is shifting from a silver exporter to a net importer. The global market used to have a steady faucet called China. Now that faucet has stopped supplying water and has started drawing water out of the market instead. The third straw is investors. This one may be the most familiar to you. In 2026, investment demand for coins and silver bars is expected to reach 2.576 billion ounces, up 18% from last year. Who's buying? Gold is too expensive. 1 ounce costs over $2,000, so ordinary people can't afford to buy several ounces. Silver has a lower entry price at just over $70 an ounce. For a few thousand yuan, you can buy a silver bar. And silver has industrial demand behind it, so it isn't purely an emotional asset. When fear spreads across global markets, silver bars and coins flow into safes. Once that silver goes in, it doesn't come back out. A safe only has an incentive to take silver in, not to release it. Unless silver prices crash so badly that everyone sells at a loss, investment silver just becomes dead inventory. Do you know how tight the retail market is this year? Some dealers' premiums on physical silver coins have risen above 15%. In other words, the official spot price is $77, but buying one coin actually costs you $88 to $90. Dealers have very little stock, and restocking has gone from 2 or 3 days to 2 or 3 weeks. Some popular products are completely sold out. After placing an order, you may have to wait a month for delivery. This kind of retail tightness is the clearest sign of a liquidity problem. Now, put these three straws together. India is systematically drawing in silver. China has shifted from exporting to importing, and investors are stockpiling silver. Three straws are stuck into the same glass of water, and there's still only so much water. The straws keep getting more numerous and thicker. Sooner or later, the glass runs dry. That's what I mean by the straw effect. Any one straw alone isn't fatal. India buys more? No big deal. It has bought before. Chinese domestic demand grows? No big deal. Production is rising. Investors stockpile silver? No big deal. If prices fall, they'll sell. But what happens when all three are drawing at once? Who gives way first? The answer is nobody, so the market can barely breathe. At this point, you may be asking, don't people say solar power consumes the most silver? There are countless videos online titled "Solar Power is going to use up all the silver." But did you look at the data I just gave you? Solar silver use is expected to reach 151 million ounces in 2026, down from the 2024 peak of 197.5 million ounces, a drop of nearly 24%. Solar isn't consuming more silver. It's desperately trying to save silver. Why? Because silver is so expensive that it keeps solar manufacturers awake at night. Let me do the math. Silver paste is the conductive layer in a solar cell. Those fine silver lines you see on the surface of a solar panel are printed on with silver paste. Heraeus, one of the world's largest precious metals processors, says silver paste can account for 30% of a solar cell's total cost. 30%. Think about that. Nearly one-third of the cost of a solar cell is silver. The average silver price topped $30 in 2025, then surged to $120 this January. Solar components already have paper-thin margins. Chinese exporters have been locked in a price war, and some manufacturers make less than 5%. Ask a manufacturer earning 5% to absorb a 3 or 4-fold jump in material costs. If it doesn't save silver, it has to shut down. So manufacturers took action. Longji Green Energy, one of China's solar leaders, announced this year that its copper-replacing silver technology for BC cells would enter mass production. BC cells have a special structure with all their electrodes on the back, making them ideal for replacing silver with copper. Heraeus is also adjusting its strategy. Industry reports say it has scaled back some of its solar silver paste operations in China and Singapore. Even the silver paste suppliers themselves believe the market is changing. Other technologies are moving forward too. Silver-coated copper, where a thin layer of silver is plated onto copper particles, combining silver's performance with copper's cost, and copper electroplating. That means depositing copper directly onto the cell through electroplating along with low silver pastes. Manufacturers are changing the formula and cutting the silver used in each cell. In 2020, one solar cell might have used 100 milligrams of silver. Now, some manufacturers have reduced that to below 50 milligrams. Technology is saving silver, but don't assume that's bearish for silver. Quite the opposite. It proves one thing. Silver has already been forced into the B supply chain to save itself. When does an industry desperately pursue substitutes? When raw materials become too expensive to bear. Take oil. When it hit $140 or $150 a barrel, the whole world rushed into renewables and electric vehicles. But look at what happened. Renewables have been developing for over a decade. Has global oil demand fallen? No. In 2025, global oil demand is still hitting record highs because the oil saved by alternative energy can't keep up with new demand emerging elsewhere. Solar is saving silver, that's a fact. But India is ramping up, investors are stockpiling, and China is absorbing more. What gets saved isn't enough to offset what's being taken away elsewhere. The more than 40 million ounces saved by solar still aren't enough to cover India's import increase in just one quarter. It's like pulling one drain pipe out of a bathtub. Water stops flowing through that pipe, sure, but then you turn on 3 faucets above the tub. The water level is still falling. And don't forget, solar is saving silver, but one sector's silver use is quietly rising. Artificial intelligence. You heard that right. AI uses silver too. How? Through data centers. The world is building data centers like crazy. NVIDIA's GPUs need somewhere to go. Computing power needs electricity, and electricity needs transmission networks. High-voltage contacts, relays, and switchgear in those transmission networks all need silver. Silver is the most conductive metal there is. Better than copper, better than gold. Where extreme conductivity is required, copper can't replace silver. Data center server boards contain silver, so do memory interfaces and cable connectors. Electric vehicles are the same. A traditional gas-powered car uses roughly half an ounce to 1 ounce of silver. What about an electric vehicle? According to the International Energy Agency, an EV uses about twice as much silver as a gas-powered car. The battery management system needs silver, the charging port needs silver, and the electronic control unit needs silver. For every 1 percentage point increase in the global EV penetration rate, silver, so demand rises too. These demands build gradually, unlike solar, which surges and then falls back. It's like boiling a frog in warm water, a little more every year and a little more again. By the time you notice, AI and EV silver demand combined will already rival solar. So the real picture is this. Solar saves silver, while AI, electric vehicles, and energy storage add demand. Whatever solar saves gets added back elsewhere. The total hasn't changed much, but the structure has. Silver-using industries are more spread out now. Everyone uses a little, and nobody can do without it. Silver is becoming the industrial world's two-part adhesive. What's a two-part adhesive? Every factory needs a tube of it, but nobody builds a factory just to make it. It seems insignificant, but without it, nothing sticks. One last point may have escaped many people, but it's more important than all the data we've discussed. In November 2025, the United States Geological Survey released its latest critical minerals list, and silver was included for the first time. You may think, so what? It's just a list. What difference does being on it make? A huge difference. Critical minerals are raw materials the U.S. government considers capable of directly threatening national security and the economic lifeline if supplies are cut off. What used to be on that list? Lithium, cobalt, rare earths, graphite, and tungsten. All strategic resources you've heard about in the news. Now silver is on it too. A metal once treated as gold's sidekick is standing on the same list as rare earths. That change in status comes with a whole series of policy tools. First, expedited approvals. Domestic critical mineral mine projects can enter the FAST-41 process. A mine that once took 7 years to approve might get approved in 3 or 4. The United States wants to accelerate its own silver production. Second, federal subsidies and tax breaks. Mines can receive government money to expand, and companies that recover silver can get tax relief. Third, strategic stockpile purchases. The U.S. government may start strategically stockpiling silver, just as it stockpiles oil and rare earths. That adds another buyer to the market, and this buyer's budget is practically unlimited. Fourth, and most aggressive, a Section 232 investigation. You may remember Section 232. In 2018, Trump used it to impose a 25% tariff on global steel and a 10% tariff on aluminum. What was the justification? Steel and aluminum imports threaten U.S. national security. Do you remember the impact? Global steel trade was thrown into chaos, affecting Canada, the European Union, and Japan. Steel prices surged inside the United States, and downstream manufacturers complained bitterly. Aluminum was the same. Coca-Cola said cans were more expensive, brewers said packaging costs had risen, and aircraft makers said aluminum had become costly. One tariff decision traveled from the steel mill all the way to the supermarket shelf. It only took a few months. Now, silver is a critical mineral. What if one day the U.S. government decides silver imports threaten national security? I'm not making this up. The legal pathway between the critical minerals list and Section 232 is already there. We've seen it before. More than 70% of America's silver is imported. Domestic mines fall far short of demand. The main sources are Mexico, Canada, Poland, and China, with Mexico the biggest supplier. You heard that right. Mexico, not China. Mexico exports huge amounts of silver to the United States every year. If U.S.-Mexico relations sour, silver becomes a bargaining chip in trade talks. America's silver supply chain could become extremely vulnerable. If tariffs hit silver imports, global trade flows will be reshuffled. The pipe doesn't just get narrower, it turns completely. Mexican silver could become 25% more expensive, while Chinese silver might be shut out entirely. Do you think that could happen? Silver's biggest variable over the next 3 years isn't solar panel demand or how much silver gets used. It's whether this pipe gets deliberately cut off. When a metal meets 3 conditions at once, supply and demand can no longer fully explain its price. First, factories need it. Second, investors hoard it. Third, governments classify it as a strategic resource. Silver now meets all 3. It has become a policy variable, and one government order can change its price. Think rare earths, chips, and lithography machines. They all went down this road. Silver is joining that club. So let's return to the water tower and pipe from the beginning. Is there water in the tower? Yes. 610,000 tons, enough for more than 20 years. But what about the pipe? It's getting narrower and more clogged, while people keep adding valves. India added one, China added one, and the U.S. government may add another. The narrower the pipe, the less stable the water pressure, and the less stable the pressure, the more the faucet alternates between spraying and stopping. $120 spray, $77 stop. That's the underlying reason for silver's performance this year. The water tower isn't empty. The pipe is the problem. Of course, this isn't telling you to rush out and buy silver bars. Silver is extremely volatile. It surged to $120 in January, then fell back to $77 in May. It's not a one-way ticket. If you put half your savings into silver bars, could you handle a 20% drop in 1 month? If you bought 10 silver bars at January's peak, you've already lost the equivalent of 3.5 bars. That money could buy a pretty good electric motorcycle. So I'm not giving investment advice, but remember these 3 numbers from today's episode. The first number is 23.5 years. That's silver's reserve life. There's still silver underground. The water tower isn't empty, so don't let claims that it will disappear in 10 years scare you. The second number is 46.3 million ounces. That's the projected market shortfall for 2026, just 4% of total demand. 4% doesn't sound like much, but in a market with only 136 million ounces of freely circulating inventory, 4% is a ticking time bomb. The third number is 129%, India's year-over-year growth in silver imports. A country of 1.4 billion people is turning silver from jewelry into a financial asset. That straw has only just entered the cup. Together, these 3 numbers tell you one thing. Silver's problem isn't that it doesn't exist. It's that it can't move freely. If you're watching clean energy, artificial intelligence infrastructure, or the restructuring of global supply chains, this silver pipe is worth monitoring. Not because silver must rise, but because the narrower a pipe gets, the more suddenly it can burst when you aren't looking. When that happens, it won't just affect silver prices. It will affect the cost of solar panels, electric vehicle components, invisible silver contact centers, and the impossibly thin silver coating on your phone's motherboard. It will affect the metal consumed worldwide every year in tiny fractions of a gram. Nobody talks about it, but everyone depends on it. Ask a factory owner, is silver important? He'll say, "Not really. We use very little." But try cutting off the silver, and his production line stops the very next day. That's what's so strange about silver. It isn't as visible as oil, as high profile as chips, or as politicized as rare earths. It quietly sits in every circuit board, every solar panel, and every switch contact. You can't see it, but it's everywhere. And its pipe is getting narrower. The problem with the pipe has never been just a problem with water. Look at human nature through money, and look at the truth through power. I'm Money Daddy. See you next time.